Hey everyone, and welcome to this tutorial, I'm going to call it, of the Nationwide 401k plan, pension plan, and 457, otherwise known as Deferred Comp plan. Not everybody is eligible for all of these plans, so I just want to state that right up front. But we've received a lot of questions, especially recently, about these different 401k or retirement plans, I should say. And so I just decided as I was going through all the materials, deep diving into the plan documents, that maybe it made sense if I was learning it and explaining it to a few of our clients, that maybe it made a whole lot of sense to just make a video just like this and make it available to everybody, so that if you have trouble understanding your own retirement plan at Nationwide, or if you're a former employee at Nationwide, that maybe you can kind of wrap your head around a relatively complicated plan. The 401k plan is not that bad. The 457 is pretty straightforward as well, but the pension plan right there in the middle, it's a bear. It's a tough to understand retirement plan, that's for sure. So my name is Adam Koos. I'm president, senior financial advisor, and portfolio manager at Libertas Wealth Management Group here in Central Ohio, Columbus, Ohio. Our office is at the corner of Riverside and Henderson Road for those of you who are local. And obviously Nationwide is a local company headquartered right here in Columbus, Ohio. So I assumed that I could share those details. So if you have any questions at the end of this video, I'll have our contact information. You can email us, call us. If you'd like a second opinion on your financial plan, retirement plan, your investment portfolio, that's what we do here at our office. So feel free to reach out. All right, let's jump right into the materials here. Starting with the Nationwide 401k plan, just a couple introductory notes. This is also called the Nationwide Savings Plan, by the way. I think they could have made it a whole lot simpler if they just call it the 401k plan, but it's called the Nationwide Savings Plan, and that's opposed to the pension, which is called the Nationwide Retirement Plan. So the Nationwide Savings Plan is the 401k plan. The way it works is everything's accessed through Fidelity Net Benefits, and the website's right there. It's netbenefits.com/nationwide. You can also reach them via phone. I put the phone number here just for your convenience, 800-238-4015. And then Fidelity Brokerage Link. They have something that's not so well known and really not so common amongst 401k plans, or at least participants aren't aware, and that is being the ability to self-direct your funds in an independent account, like a retail account. So as opposed to using your standard fund lineup, which is typically anywhere between, in any 401k plan, and the standard would be 10 funds up to, say, maybe 20, 25 on the high end, you would have the ability to put money into the self-directed brokerage account at Fidelity Brokerage Link, which would give you the ability to put your money into anything, virtually any investment you wanted within reason. So that's available. In order to use Brokerage Link, it's important to understand you have to open up a new account. There's some minimums. We'll get into that a little bit later. But let's just kind of get through some of the basics of the 401k plan first. There's a 50% match on the 401k up to 8% of your contribution. So if you put away 4% of your income, then you're going to get a 2% match, essentially, mathematically. If you put away 6%, you're getting essentially a 3% match on your income. But if you put away 8%, you're getting 4%, so you're maxing out your matching formula. I have rules of thumb. I always say that in order to be saving semi-properly for retirement, what you want to do is have at least 14 to 16% of your income being saved, including the match. So in this case, if you're getting a 50% match up to 8%, that's essentially 4%. So if you're putting away 10% of your own money, then you've gotten yourself to 14% of income. If you want to do better, obviously, the best thing you can do, a goal would be to max it out. Well, what's the max? 2023, $22,500 is the max. And if you're over 50 years of age, there's a catch-up contribution. You can put away an additional $7,500. And also, a not so well-known fact is that your match is in addition to your maximum contribution. So you can max out the 401k, and the money that you get from your employer is on top of your maximum contribution. So just keep that in mind. So let's move forward here and talk about fees and expenses. The Nationwide Savings Plan or 401k plan has asset-based fees that include primarily expense ratios, which is just a fancy phrase for investment costs. So there's always costs inside investments. You don't see them. It comes out of your returns before you even get your statement in the mail. All these investments obviously are not working for charity, so they are working for a profit. So there's always going to be some asset-based fees inside the plan. There's also administrative fees. They can include costs for legal fees, accounting fees, trustee, record-keeping fees, and any other fees maintaining regarding the maintenance of the 401k plan. So, for instance, with the nationwide plan, a record-keeping fee of $27 to $37 per year is deducted from each participant's account, and that's deducted quarterly. So, depending what the fee is, to divide it in 4, and then once a quarter, that money comes out of your account. And then there's individual expenses for fees related to loan setup. So if you ever borrow money from the plan, maintenance on the loan, overnight mailing if you need a check, there's a fee for that. There's financial engines, which is an add-on retirement planning software that you can use if you'd like, and it's an additional 0.33% per year in order to use that. And then if you get divorced, there's fees having to do with putting together what's called a quadro, or a qualified domestic relations order. So that there's kind of various fees within the plan that you just need to be aware of. As of March 13th, these are all fees, investments inside the plan. I'm going to do my best to update this maybe once a year, just with new information. Might even just throw a little screenshot on top of it with updates as opposed to re-recording the whole thing. But as of March 13th, 2023, we have 8 domestic and international stock funds that are inside the nationwide plan. There are 11 target date funds. So those are funds that are essentially supposed to be used in a way where you might invest your money based on the year you're going to retire or close to that year. And the idea is the closer you get to retirement, the more conservative those funds get. In other words, they become less invested in stocks, more invested in fixed income, cash equivalents, and things of that nature. Some people use them just discretionarily to buy a more aggressive or more conservative fund of funds. That's fine too. But you've got 11 target date funds. You then have 4 fixed income, or in other words, bond, money market blended funds as well. You've got 1 guaranteed fund, which is currently paying 3.08% at the time of the recording of this video. Or I should say, when I got the documents here, the documents were as of March 13th. So I'm recording this video, I believe it's June, I don't even know what the date is, June 22nd. So June 22nd, 2023. Finally got around to recording this video, but these numbers are as of March 13th, so it could be higher. And then we talked about this already a little bit, but Fidelity Brokerage Link is another, I don't want to call it an investment option, but it's a separate account that you can use in order to invest your money in pretty much whatever you want. So let's talk about Fidelity Brokerage Link, which is essentially a self-directed 401k plan. Your investment elections through Brokerage Link, they cannot exceed 95% of the total balance. So in other words, when you look at your total 401k plan, if you have some money in the traditional 401k and money inside the Brokerage Link option, you have to have at least 5% of the total in your traditional 401k option in order to use Brokerage Link. The minimum to set up an account is $2,500 as an initial investment to set up Brokerage Link. Any future exchanges into Brokerage Link from your traditional 401k plan are not allowed if the transfer results in more than 95% of your money total in both the Brokerage Link and your traditional 401k plan being added to Brokerage Link. So again, you got to stay under 95%. And then Brokerage Link is also subject to asset-based administrative and individual fees as well. So it's an additional benefit, but they do have their own fees as well. Mutual funds are going to be anywhere between $49.95. There's trading fees you need to keep in mind, 60-day limits. They don't want you trading like crazy. $49.95 is the low end, to up to $75 per trade if you execute it online and do it yourself. $250 is the maximum fee if you do what's called a rep-assisted trade. That just means that you're getting help from one of their traders. There are standard loads, or in other words, commissions. Load just means commission, that apply whenever applicable. And the reason they say whenever applicable is because, again, Brokerage Link is basically a self-directed account where you kind of pick almost any investment you want. And so therefore, there might be investments out there that have front loads, back loads, and so on, penalties to get out. And then, like I mentioned earlier, the short-term trading penalties. If you're buying individual stocks or ETFs, exchange-traded funds, inside Brokerage Link, which you can, by the way, it's one of the benefits, there are no trading fees if you execute them online yourself. If you use Fast, it's going to be $12.95, or if you're calling in and having someone help you, it's going to be $32.95. Then there's a fee of 1 to 3 pennies, so 1 to 3 cents per $1,000 of principal is charged by Fidelity on all sell orders. So a little fine print there. Foreign stocks. If you buy international foreign stocks, there's a trading fee of up $50 per trade, up to 0.3%, 0.3% of the total execution price. So total trade. Again, kind of continuing with the fees here for investments inside of Brokerage Link. Again, there's a lot to go over here because Brokerage Link's a big deal. There's a lot going on. You've got treasuries, so U.S. Treasury bonds, Treasury inflation protected securities, which is what TIPS stands for. You've got bonds, so individual bonds, CDs, and treasuries and TIPS. There's no fee if you execute them online, just like executing a stock trade or an ETF trade. There's no fee. And again, there's a rep-assisted fee. If you call in and you get help from someone, a live person, you're going to pay a fee per trade. All other bonds are $1 per bond, so per par value. So keep that in mind. So it's not if you buy, one bond, you're gonna pay $1 per bond. But if you're buying, thousands of dollars worth of a bond, you're going to pay more than $1, of course. Again, $19.95 minimum if rep assisted for a bond trade. CDs, if you buy them in the primary market, meaning if there's a list of CDs you want to buy through Brokerage Link, there's no cost to buy it. But if you're buying a secondary market, so in other words, a CD that's already been issued, it's been out there for 2 months, it's got a maturity date of 1 year, but it's 10 months left, you're going to pay $1 per par equivalent of that CD in order to pay for that investment. For stock options, or really any options on ETFs, you're not going to pay anything if you, again, trade online. It's, again, $12.95 via FAST and $32.95 if rep assisted, plus $65 per options contract on top of that. Other fees exist to close trades, multi-leg orders. So if you're looking at more complicated option strategies, the fees can get larger. Just want to keep that in mind. And then commercial paper, again, fixed income instruments, it's $50 per transaction, $35 minimum fee per redemption on UITs, which is unit investment trusts, and things like that. So before I move on, that's kind of a brief overview of the Nationwide 401k plan, the different investments inside of it, the fees. Obviously, spent a lot of time on Brokerage Link, so I guess just keep in mind that most people probably aren't using Brokerage Link unless they're a sophisticated investor and they want to have the ability to really trade in their own account and buy whatever they want. It's a great benefit, Brokerage Link is, but typically what we see is people using their traditional 401k fund options, paying attention to them, maybe making a change once every 3 to 6 months or so. Our clients just reach out to us and say, hey, is now a good time to make an allocation change, and we'll help them make the allocation change for free. So you don't need to get into Fidelity Brokerage Link and make things this complicated is I guess what I'm saying. So don't let this overwhelm you. You could just completely avoid Brokerage Link altogether, keep things simple, which is again what most people do. All right, let's change gears and talk about really what we're going to spend most of our time talking about today, which is the Nationwide Pension Plan, which is extremely complicated. There's a lot of history here. There's tenure that's carried over from prior companies from years ago in the 90s. There's all kinds of rules and things we need to keep in mind. So I'm going to go through everything in detail. And again, this is now to try to get through the minutia. This is the Nationwide Retirement Plan. So the Nationwide Savings Plan is the 401k. The Nationwide Retirement Plan is the pension. And as we get into the pension here, first of all, we need to understand a pension is a 100% employer-paid defined benefit plan. In other words, this is not something you can put your own money into. This is a pure nationwide provided benefit. They're giving you free money, essentially, is the way this works. So it's a company-based pension. You don't see a lot of these anymore these days. Some people have been grandfathered in depending on when you began employment. So I guess now's a good time to say that this doesn't really apply to a lot of people. But for those of you that do have it, who've been with Nationwide for a while, it's again complicated. So which is exactly why we're doing this video. Employees cannot contribute again. They do not and cannot contribute to this plan. Sorry about the typo there. So this is not a defined contribution plan. This is not a 401k plan. It's a pension plan, defined benefit plan, which means that all the money that's contributed comes from the employer, not from the employee. And while the employee retirement benefit is given to you, there's also a vesting schedule, which just means that you need to stay with Nationwide for a period of time, a certain period of time, before you're allowed to take this money with you. And the reason they do that, obviously, is because they don't want to give a bunch of free money away and then have people just leave and take that money with them after working a very short period of time. So let's go over some rules and definitions first, so we understand what we're talking about here. First of all, there's two formulas with the pension plan, the retirement plan at Nationwide, and that is final average pay, or you'll see me calling it FAP or FAP, and then the account balance benefit, or ABB. So those are the two formulas, and we're going to talk a lot about this. If you were hired before January 1st of '02 and you worked continuously and you've reached 55 years of age by 12/31 of 2016, then your benefit is calculated using what's called the final average pay formula, so the FAP. If all other conditions apply but you did not reach 55 years of age by 12/31 of 2016, then your benefit would be calculated by adding the benefit accumulated through December of 2016 under the FAP formula to any account balance benefit accumulated thereafter. So basically you'd be using both formula, one for before 2016 and one for after or since then. The next thing to understand is that if you were hired or rehired, for that matter, after January 1st of '02, your pension plan is calculated using the account benefit balance formula. If you worked for Nationwide before January of '02 and you were rehired, there is still a possibility that you've been grandfathered into the FAP benefit. So just keep that in mind. So that not to make this even more complicated, but a lot of this depends on when you started, when you quit. But even if you did quit and you were rehired, there's a chance that you were grandfathered in and you could continue. You can begin taking your pension benefit after your employment ends, but you can also choose to defer the commencement of benefits until a later date. It's up to you. All right. So all monthly payment options provide an income that lasts for life, or that can last for life, I should say. So this is, again, with the pension plan. Certain benefit options may also provide survivorship benefits after your passing. Survivorship benefits just mean that if you're married, you have a partner, and something happens to you, you can have a percentage of your monthly payments go to your spouse or partner when you're gone. That could be 50% of it. It could be 75%. It's just the more that you pass on to your beneficiary, the lower the initial starting amount's going to be. Just keep that in mind. Now, this benefit does not affect your ability to earn or the amount you will receive from Social Security. So your Social Security income is not affected by this pension plan, which is very different from STRS, so State Teachers Retirement System, Public Employees Retirement System, which is PERS or OPERS, people call it, and SERS, which is State Employees Retirement System. So with those three pension plans to the state, it does affect your Social Security, something called the windfall provision. But that has nothing to do with this presentation, so we're not going to talk about it. But I just want to make it clear that your pension does not affect your Social Security. You will get your full Social Security amount that you've earned and this pension if you qualify for the pension. Now, not all companies that are part of Nationwide offer this plan. I know that this is going to be probably a minority of you, but if you work for one of these non-participating employers, you're going to accrue what's called months of eligibility service, months of vesting service, and months of accrual service during your period of employment. If you also had accrued benefit under the FAP formula before transferring to a non-participating employer, that benefit will continue to be indexed based on changes in your covered compensation. I know, clear as mud, right? So as we go through this, even if you're with a non-participating employer, there's a chance that you can still benefit from the pension. If as far as eligibility, who's eligible to be a part of this, it would be a Nationwide employee that's 21 years of age, had received, if they had already received a 1-year anniversary after their date of hire, that's what DOH stands for, and they would automatically have become a participant on January 1st or July 1st following the above prereq. So if you were 21 and you had achieved 1-year anniversary, then whenever your next 1/1 or 7/1, whatever the next date is, that's when you would be automatically included. For the people who are excluded would be NADP, NBAP, and FADP agents, agency capital builder 1 agents, non-resident aliens receiving no earned income from Nationwide within the U.S., which you would think that'd go without saying. Those retained to work on a discrete project or just creative matter, so think 1099. employees, independent contractors, and then leased employees with non-nationwide companies working as contractors. So none of these people would be eligible, obviously, to have ever received or been a participant in this pension plan. Every hour worked, from an eligibility standpoint, gives you 1 hour of service, and that's whether you're with a participating or non-participating employer. The credit is also received for covered compensation. So we're going to talk about that a few times too. So remember that phrase, covered compensation. So when you receive credit, this also includes holidays, vacation pay, illness, short-term disability, and so on. So just because it's a holiday or you've taken vacation time doesn't mean that you lose that credit. You would actually still continue to get it. So keep in mind there's also different rules for those who were in the pension plan pre-Jan 1 02. That would be something we would have to calculate. And I guess I should say, I'll probably say this a few more times, but I'll say now that anybody who wants help with this, what we do is we typically get on the phone with our client, we call Nationwide, we talk to the HR benefits, we talk to Fidelity, and we work everything out to kind of figure out what makes the most sense for you. In other words, we want to understand your plan because there are so many moving parts here and there are so many variables that to create blanket advice with this video or an article or anything for that matter, like the plan document and the brochures that you've probably received over the years that you never opened because they're so complicated, what's the point in reading them? If you need help with this stuff, what you really want to do is we want to jump on the phone, we want to maybe even do a Zoom meeting with somebody in HR, and we can do most of the talking and try to figure out, okay, what is my benefit? Based on my years of service, when I was hired, if I left and I was rehired, what the rules are there, which we're going to talk about that in a second here as well. So anyway, I digress. All right, so vesting schedules. 1 month of vesting is for each month of hour, you receive an hour of service. That's the vesting schedule. So in other words, for every hour of service, you get 1 month of vesting. And that's how you qualify to take this money with you when you leave. You're vested in your accrual benefit once you've received 36 months of vesting. And again, here we go with another caveat. Different rules apply for pre-2008. Participant service for the FAP benefit is calculated the same as above, but if you became disabled, so if disability came into the picture before January 1st of 2010, your period of disability may also be counted as participation service in the pension plan. Now, accrual service, because again, there's all these definitions here, is the service you used when calculating your account balance, so for your pension. And that is credited the same as your accrual benefit and the FAP formula. So, and again, I have to keep saying if applicable or if it applies to you, because not everybody, this does not apply to everybody, this plan. And obviously, if it does apply to you, every one of you could be potentially in different situations depending on when you started, when you were hired, how long you've been with Nationwide, whether you were with a non-participating employer at any point during that time, and so on. When you're on military leave, the Uniformed Services Uniformed Services Employment and Reemployment Rights Act makes it such that the plan administrator will provide benefit and service credit up to a maximum of 60 months of credit for each period of military service. So if you have multiple tours, if you're deployed multiple times, that 60-month clock starts over. And when you're rehired and you return to work, then obviously you are credited that service. For the purposes of FAP, you'll be treated as not having incurred a severance date. In other words, there wouldn't have been a date that you would be officially severed from employment in that case. So it's almost like you never stopped working. So talking about covered compensation, I mentioned earlier when I remember that phrase. So covered compensation is used to determine your pay credits under the account balance benefit formula, the ABB formula, as well as when determining your final average compensation for the FAP formula. I know, it's for those of you who are sticking with me this long, I apologize that this is so complicated, but trust me, stick with me here. Hit pause, rewind if anything doesn't make sense, and it'll start to come together, I promise. Each year, your covered compensation is what's reported on your W-2 minus payments made after termination of active employment. So severance pay, unused vacation, those don't count, if that makes sense. Same thing with ineligible compensation, retention bonuses. So if you're being given a retention bonus to stick around for a year before cutting bait and retiring, for instance, any expense reimbursements that you may have been given, allowances for expenses, Gross up payments, payments to offset taxes for if you've been relocated and Nationwide helped pay for your relocation, that would not be included in covered comp. Income imputed to you due to health or other benefits to dependents of yours, kids, domestic partners, as well as executive benefits paid under any sort of long-term performance, equity plan, and so on. Subsidies, reimbursements for the loss of a company car. Now we're getting a little bit into the weeds here. What are the probabilities of this actually happening? Probably small, if at all. Makes me wonder if it's ever happened, by the way. And then lastly, we'll talk about deferred compensation last year, but here again, deferred compensation paid to you prior to your severance date it would not be included as well. All right. More on covered compensation. Then, after subtracting all of those things, we add the following back into the calculation. So, in the amounts where you deferred on a pre-tax basis into a Nationwide savings plan, which is, again, not this plan. The Nationwide savings plan is the 401k. Anything you contributed pre-tax to a medical, dental, or similar benefit plan maintained by Nationwide, like an HSA plan, for instance, or any contributed pre-tax to a medical or dependent daycare flexible spending account, or FSA, maintained by Nationwide as well. Now, please note, the code limits the maximum amount of compensation that the plan administrator, this isn't a Nationwide rule, this is just a max compensation rule, that the plan administrator can use to determine your accrual benefit, which is $330,000 for 2023. And just so you know, it has increased in the past over time, and it's likely that it will continue to increase in the future, just through inflation. All right, last couple things on covered compensation. Final average compensation. This is where we start figuring out, okay, how much are we going to get from our pension plan? So unless otherwise noted, your final average compensation considers your covered comp during a 10-year period, starting with the calendar year of your employment, the calendar year your employment ends, and the 9 prior calendar years in which you had 1 hour of service throughout that year. So for a month of participation services on or after January 1st, 1996, you see how far this goes back, this would be the average of the highest 5 consecutive calendar years. So for months of participation services on or after Jan 1 of 1996, it's the average, so total average of the highest 5 in a row calendar years. For farmland participation service that began before Jan 1, 96, and there can't be too many employees that have been around or still around that long, but the calculation is a little bit different. It's the average of the highest 4 years of the past 10, having nothing to do with consecutive years. I'm going to butcher this name, but I think it's Wausau participation service that began before Jan 1, 96. It's the highest, the average of the highest 3 consecutive years. So we're back to consecutive again, but instead of 5, it's 3. And for nationwide participation service before January 1st, 1996, it's the average of the highest 3 consecutive years. Now, for former Provident participants, employees, different service periods and final average calculation definitions apply. I don't think this is all that important because there's probably 1 of you, 2 of you who are watching this video where this may apply. In fact, most of you have probably not been working with Nationwide since the 90s. Probably pretty unlikely. I know there's some of you I've seen. I know some of you, but very few. Okay, let's talk about calculating the accrued benefit. So your accrued benefit's the annual annuity. Annuity just means monthly payable amount to at your Nationwide retirement date, so when you retire, or your current age if you've already reached your retirement date. If you were an employee as of December 31st, 2001, and earned a month of accrual service for January 1st, 02, you've been continuously employed since then, and you were 55 years of age or older as of 12/31/16, the plan administrator will calculate your benefit using, again, the final average payer FAP benefit formula. If you were accruing benefits on 12/31/16, transitioned from the FAP benefit formula to the account balance benefit formula as of 1/1/17, then both formulae will be used for the before and after. In other words, we'll combine the two. And if you earn your first month of accrual services after Jan 1/02, the account balance benefit formula is used to determine your accrual benefit. So kind of 3 options there. It's either 1, the other, or a combination of the two, depending on how long you've been with Nationwide and those dates in question. And obviously that first one's pretty complicated because we're talking about age as well. So to talk about the FAP benefit, here's how it works. The single final average pay benefit applies to service after 1995, and this is how it works. You take 1.25% of your final average compensation plus 0.5% of your FAC in excess of your Social Security covered compensation times your years of participation services with a maximum of 35 years. So you can't go, 35 is the max. Now, if we take the FAP benefit and take this further, those who've had service prior to 1/1/96, again, very few of you, the FAP benefit's segmented based on the formula associated with the company you worked for. So before 96, you could have been with Farmland Mutual or with Nationwide. So we've got pre-96 service with Farmland Mutual, pre-96 service with Nationwide, and then post-1995 service with Nationwide under the new company. The plan administrator calculates each segment using your compensation through your severance date, so the day you quit, so your benefit will continue to change along with covered compensation. So if you get a snapshot now, and then we look at it again a year from now, it's going to be different. For the very few of you who are former Provident Mutual employees, your pre-Jan 1/03 benefit is calculated using the Nationwide Life Insurance Company of America plan, so a little bit different. Again, very few of you, so I don't want to spend too much time on it. All right, another calculation example here. This is the account balance benefit formula. It's a notional account that's converted into a single life annuity. SLA just stands for single life annuity. So this gets calculated into a single life annuity payable at age 65. So this is most people. So most people who are in the Nationwide pension plan, most of you are probably going to be using this calculation, which is payable at age 65. And this is how we determine it. We take the initial account balance plus any pay credits plus interest credits. And then from there, for rehires, there are special circumstances, which I'll go over just in a few minutes here, that do apply to some people. But this is what we're looking at when we're looking at your account balance to determine your single life annuity. If you're wondering about payments, by the way, if you're going, well, wait a minute, that doesn't really tell me what it's worth. It doesn't tell me what I'm going to get. Well, in order to find out what you're going to get, we have to know, first of all, we have to know this calculation. And then second of all, we have to know, are you going to take this over a single life? Are you going to take this over a period certain, like 5, 10, 15, 20 years? Are you going to have a survivorship benefit with a spouse or partner where you give 50% or 75% to them if they leave? So there's a lot of moving parts here. And this is, again, I know I've said it before, I'll say it again, why it's so important to have a sit-down discussion and conference call with Nationwide Benefits, which is something we do with our clients all the time that either currently work or used to work at Nationwide. All right, let's see here. Account balance benefit. Your pay credits are equal to a percentage of your covered comp, which is based on your months of accrual service through December 31st of the prior year. So it's calculated at the end of the year. So if you look at your months of accrual service here, you can see in this table that, on the far left here, months of accrual service through December 31st of the prior year, you can see if it's fewer than 36, then pay credits are at 3%, plus pay credits on covered comp over the Social Security wage base, which is another 3%. If you're between 36 and 107 months, then it's 4% and 4. 108 to 179, it's 5 and 4. And you can see how this changes as time goes on. So the more time you have, then the higher the pay credits. This is timely, I guess, but again, something I'm probably going to have to update each year as the laws change for Social Security. But the Social Security wage base for 2023 is $160,200. And then interest credits are credited each payday using the 30-year Treasury yield. So that's where these interest credits come from. If you cared. All right. Conversion from final average pay to ABB. So if you had accrued benefits under the FAP benefit formula back in 2016, so 12/31/16, but you had not yet attained age 55, then your overall accrued benefit under the plan would generally be equal to the sum of your FAP benefit you accumulated through December 31st, 2016, plus the account balance benefit you accrue after then or since then. So the FAP benefit earned prior to 1/1/17 will be preserved. You're not going to lose that. Now, when we talk about integrating this with Social Security, our Social Security income, both the ABB and FAP benefit formula integrate or coordinate, maybe a better word, benefits with Social Security income. The plan, however, does not reduce your plan benefit on account of any benefits you receive from Social Security. So again, I just want to make that clear. We've already said it once, but here's how integration with Social Security works. Number one, the FAP benefit formula provides higher benefits for the portion of your final average pay that exceeds Social Security covered comp. And two, your pay credits under the ABB formula, account balance benefit formula, are higher for pay in excess of the Social Security wage base. So Social Security covered comp is determined by averaging the Social Security wage base over a 35-year period, which again is the max for the pension, ending with the calendar year in which you receive Social Security retirement age. This I have a little footnote at the bottom there, by the way, because the Social Security wage base is increased almost every year. Obviously, the Social Security covered comp is different for each year of birth, and there's always one of the most common questions we get is Social Security going to be there for me when I retire? We get this most usually from people in their 40s or younger, but the answer is I think that if you're in your 40s or older, chances are it's going to be there exactly how it looks today. If you're under 40, I think there's probably a good chance they may raise Social Security retirement age. They might get rid of the 62 option. They might means test it. I know it sounds terrible, but if you saved really, really well in your nationwide 401k plan, other 401k plans, Roth IRAs, brokerage accounts, your pension, if you did really, really well for yourself and saved well and you were responsible, you may actually get less from Social Security down the road. That's what means testing means. So, but nobody knows. So I don't think it pays to try and predict it, to be honest. So let's talk about retiring under the nationwide plan. So you're retired now. In order to receive the accrued benefit, you have to be vested. Because again, if you haven't been around long enough to be vested, then you can't take it all with you. So you have to be vested as of your severance date, the day you quit, which happens after you've been credited a total of 36 months. Then you're vested. So if you're vested, you can start receiving payments from your accrual benefit, which is based on your age as of your severance date and when you start payments. So when you choose to start payments, benefits can begin as of the first business day of the month following your severance date. And the paperwork has to be completed in good order. Sorry about the typo there again. So it has to be in good order as required by the plan administrator. So if you wanted to start the first business day of the month follow your severance date, but you don't fill out the paperwork right, then obviously there's going to be delays, and this stuff can take time. So at our office, we just fill out the paperwork for our clients and explain it to them, and they just sign it, and we send it in via UPS. So there's a tracking number, and there's no questions. If there's ways to accept faxes, then we can just fax it in as well, email also. Anyway, keep in mind benefit limitations. So Social Security integration and max benefits payable, and then the benefit formula assume you commence your benefit at age 65. In fact, that's the number we're always hearing. So if you start earlier, then your payments are going to be reduced. So whatever your formula depicts your monthly benefit will be. Let's just say if you chose a single life annuity with no spousal continuation, no survivorship benefits, and that number is $1,000 a month. I'll just throw a number out here. If that's the case, and you decide instead of at 65 you want to take it at 62, then your number is going to be smaller. It's not going to be $1,000 a month. It's going to be smaller. More about retirement here. This is early retirement factors. This is the specifics. So if you're wondering, well, how much less would it be? You can see here at age 65, it doesn't matter how long you've been with Nationwide or which benefit formula we use, you would essentially get 100% of your benefit. But as you take the plan earlier, the pension, if you start your benefits earlier, your monthly payments, then you can see here depending on which plan you were under. So if you're a newer employee, that's going to fall faster. If you're an employee that's been there longer, then it's going to fall slower if it falls at all. Okay, distribution options. So I'm retiring. What are my choices? How can I take this money? How do I get access to it? The first is, again, single life annuity. So taking basically a monthly payment that lasts from now to the day you die. And it's guaranteed, by the way, to last to the day you die. Life annuity period certain. That would be if I want to take it over 5 years, 10 years, 15 years, or 20 years, let's just say. So as opposed to the rest of your life, maybe you want a larger payment over a shorter period of time. There's tax reasons people might do this. There might be other strategies where maybe if they don't need this money but they want to get it faster, this is one way to get the total of your account balance quicker. A joint and survivor annuity, this is where we get into survivorship benefits. So if you wanted this to be not just a single life annuity, but a joint life annuity, you could do a 50% survivorship benefit to your spouse or partner. So if it's $1,000, I'm going to keep using $1,000 a month. But if I'm getting $1,000 a month and I pass away, then my spouse or my partner would get $500 a month. And then the same would be the case for, any of these benefit formulas. So if it's 66.6, 75%, or if I wanted all of my pension to go to my spouse if I were gone, then I could elect 100% survivorship benefit. Of course, the more I elect to go to the second beneficiary, or to the beneficiary, the more I'm spreading this out over 2 lives, and the more money that we're spreading out. So therefore, the less we're going to get initially. So think of it this way: if you don't give the money to anybody else but yourself, you're going to get the highest monthly amount. But if you give more and more away if you're gone to someone else, then your amount gets smaller and smaller, because obviously the risk is higher to the insurance company. So if your beneficiary predeceases you, this is important. You cannot designate another individual to become your beneficiary, and your total income does not change. So if you decide to do a 75% survivorship benefit to your spouse, but then your spouse passes away, heaven forbid, you can't change the beneficiary, and because obviously you chose a survivorship benefit, so your income is going to be lower now, it's not going to go back up because that spouse is gone, unfortunately. There's what's called a level income option. This is a little bit unique. It starts higher, then goes lower after Social Security kicks in. This can start as early as 55 years of age, or 52 if you're involuntarily terminated, so laid off early. It's equivalent to Social Security income. Part of your lifetime annuity is converted to an additional guaranteed payment that's paid through the month following the month in which you reach age 62. So think of it almost like covering a gap. So if I get laid off early in life, or I quit earlier than I maybe planned on quitting, and I'm looking for some extra income to help bridge the gap between now and when Social Security starts, using the level income option is one way to do that. So I guess that's what I said here. So I can bridge the gap between retirement date and Social Security commencement, if you retire or get laid off prior to 62 years of age. Then the amount of your annuity benefit, so the amount of your monthly benefit, depends on whether or not you elect to commence your benefit payments before 65, because again, if you do it before 65, they get smaller. If you have a survivorship benefit, then they get smaller. If you convert a portion of the benefit to the level income option to bridge that gap between pre-62 and 62 years of age, or if you receive a portion of your benefits in cash, if eligible, and we're going to talk about that as well. If you commence benefits before versus after 55 years of age, here's how it works. If it's before 55, you can only elect 50% or 75% joint and survivor annuity, or a lump sum payment. So you cannot do a 66.6% or a 100% joint and survivor annuity to a spouse or partner. You only have the choice between 50 or 75, which is fine, no big deal. Or you can take a lump sum payment. After 55, you can elect to receive your benefit in any of the forms we just talked about above. All right. The cash benefit. So lump sums. If you earned an hour of service between 1/1/02 and 12/31/2013, you may elect to receive a portion of your vested accrual benefit in a single cash payment. If your severance date occurred on or after 1/1/17, so if you quit after 1/1/17, this option is available at any time. How much is the available cash benefit? Well, there's how it works, and we've done a lot with these equations here this past couple of years. But if your cash benefit is $25,000 or less, that's what you're getting, is whatever the amount is under $25K. If your cash benefit is between $25,000 and $100,000, you're getting the less of that number. So you're getting $25,000. So if it's worth $35,000, you get $25,000. If it's worth $95,000, you get $25,000. If your cash benefit is above $100,000, then you would receive 25% of the total account balance. So you can see what's going on with the math here, that if you have $100,000, then you would get $25,000. But if you had $200,000, then it would be $50,000, and so on. The lump sum benefit is the total accrued benefit that can be received as a single lump sum anytime after your severance date, but you have to meet the following conditions. First, the present value of your accrued benefit cannot exceed $50K. if the present value of your accrued benefit exceeds the employer contributions with interest, if any, by more than $1,000, but not less than or equal to $50,000, and if you've not received a distribution of your available cash balance or a partial lump sum benefit another time before. So the only caveat there is if you were terminated and rehired and terminated again, which that'd be pretty unlikely, I would think, but that condition would apply. You can only elect the lump sum benefit if you also elect to receive your employee contributions with interest as well. So whatever money you've put into your own plan over the years. You cannot change or rescind your election after 120 days. This is the case for I don't want to say every pension under the planet, or under the sky, but most cases you get maybe 60 days, 120 days, you don't get a lot of time. Once you sign on the dotted line and you've decided I want a joint life annuity with a 75% survivorship benefit and no lump sum. Once you sign on the dotted line and the 120 days have passed, that's it. You can't go back. If you want to change your mind within that 120-day period, it's possible. It's a headache, but it is possible. All right, there is a death benefit because sometimes what happens is people pass away before they ever receive the pension, right? So the death benefit's provided to you have to be vested participants who die before their retirement date. The spouse can choose to elect either a qualified pre-retirement survivor annuity at the death benefit available to non-married participants, and this is payable starting at what would have been the decedent's earliest retirement date. So whatever the earliest point at which the deceased person would have retired, that's when it could start, but no earlier than the required beginning date. In other words, when the employee would have attained 72 years of age currently, and it's determined that if the employee had terminated employment on the date of death, survived at least the retirement date, and commenced a 50% in survivor annuity option. Alternatively, the surviving spouse can elect to take a lump sum in the amount of the account balance payable at the same time and in the same form as the qualified pre-retirement survivor annuity. So those are the two choices. If you're not married at the time of passing and you pass away, a death benefit would be paid to the person designated as your beneficiary as a lump sum that is actuarially equivalent to the present value of the accrued benefit under the plan. And this would be a lump sum. This would be a number that you could pull up if you wanted to talk to benefits. They could get you that number. The beneficiary may elect to receive the lump sum immediately, or they could defer receipt to a later date as long as it's paid no later than December 31st, 5 years after the date of passing. So this can be a reason you might do this is if you have some really, really high income earning years and you don't want to receive the benefit because you're worried about taxes. That might be one reason. So you might want to defer it to a date when maybe your tax bill is a little bit lower, but you have to take it within 5 years. If there is no beneficiary designated on the account, the death benefit would be paid to what's called the estate. So if there's no estate opened, the death benefit would be paid in order to your surviving children first, equally. If there are no surviving children, then surviving parents equally. And then if there are no parents surviving, then it'd be siblings next. All right, earlier I mentioned some special circumstances. We're going to talk about spousal considerations first before we get to special considerations. But if you're married on your retirement date and your spouse has to approve any form of distribution you elect that does not provide he or she with a lifetime income benefit that's at least as large as the benefit payable under the 50% joint and survivor annuity form. And the reason they do that is to make sure that, without the spouse's consent, without your partner knowing that you decide to give all your money to someone else. They just want to make sure that the spouse understands that. This can be waived if the plan administrator receives the irrevocable written consent of the spouse to electing this, which is notarized or witnessed by the plan administrator. And then your waiver and your spouse's consent names the specific non-spouse beneficiary in the particular form of optional form of distribution elected, and your spouse's consent acknowledges the effect of such consent. So again, even if you're electing a non-spouse beneficiary form using an optional distribution, your spouse still needs to consent to that as well. So again, this is just to protect the spouse. All right, when we get into special considerations here, special circumstances, the fine print as I call it, it's things like disability. So, what happens if you become disabled? Well, if you become disabled, you still may continue to receive months of eligibility, months of vesting, months of accrual, and months of participation service for the period of disability on the same basis as if it would have applied if you were an active employee, until the last day of the calendar month in which you either stop getting long-term disability payments from an employee benefit plan maintained by participating employers, or you cease receiving disability payments under the Social Security Act, so Social Security benefits. You have to be approved for disability under the employee benefit plan maintained by the participating employer, and either 1, get approved for a Social Security disability, or 2, the Social Security Administration denies your eligibility and you've exhausted all available administrative appeals. So you've tried to appeal it and you still get denied. Keeping going with the disability discussion, if the Social Security Administration terminates your disability payments, if you fail to complete the Social Security claims and appeals process, or if our long-term disability benefit payments under an employee benefit plan like Nationwide maintained by the participating employer stops, then the plan administrator will treat the date of such occurrence when these benefits stop as a severance date for the purposes of the plan and will discontinue any further accruals. Some more special circumstances here. What about getting rehired? What happens if I leave and I get rehired? Well, in some cases, the plan administrator will not recredit your service. So I wanted to put this note right up top because it is possible that you're not going to get recredited. However, if you are retired, whether and to what extent the plan administrator will recredit your service all depends on the length of the break in service between when you quit and when you were rehired, and your vesting and pension status as of your severance date. So if we expand on that a little bit and talk about recrediting months of eligibility, vesting, participation services vested at termination, if you were vested in the plan or in a predecessor plan on your severance date and you're rehired, the plan administrator will generally recredit you upon rehire, which is great. Recrediting months of eligibility, vesting, and participating service if you're not vested. Well, if you're not vested and you were rehired within 1 year of your severance date, you will not only generally be recredited, but you will also receive your service credit during your period of absence. So you get credit for the time you were gone. If you were rehired after a 1 year break in service, but before incurring 5 consecutive 1 year breaks, you'll generally be recredited once you have worked 12 full months following your retire. So if you come back after a year and you stay for a full year, then you would be recredited. If you were rehired after 5 consecutive 1 year breaks in service, however, then no service is going to be recredited and you'll be treated as a new hire. So if you leave and you're gone for 5 years and 1 day, then you're not going to be recredited. All right. There's no such thing, unfortunately, as a retire-rehire at Nationwide. And if you don't know what I'm talking about, this typically refers to people who've worked under employers who have STRS, PERS, and SERS. So if you're rehired after starting your retirement benefit, the plan administrator suspends payments. So you're not going to work for Nationwide, retire, start getting a pension, then go back and start making more money than you were when you were working. The only exception is the level income option. And again, that's the whole gap filler option. That's where if we get laid off, if we quit early, we have an early retirement, and we want to bridge that gap between an early retirement and 62, when you can start taking Social Security, that is an exception, but we'd want to have a discussion with HR and calculate your personal benefit and see how that would work if you were rehired. How do you request benefits? How do we make this all happen? First of all, notify the Nationwide Retirement Center at Fidelity, and the plan administrator will send you documentation. The phone for Fidelity is 800-238-4015. The plan name is the Nationwide Retirement Plan. Again, this is not the Nationwide Savings Plan. That's the 401k. This is the Nationwide Retirement Plan. And then if you need the plan number, it's 333. Kind of easy to remember, actually. So 333. And then if you still have more questions, I know this is complicated. It was fun doing the research for me, believe it or not. But this is an extremely complicated plan. Not everyone applies to every situation. So if you have questions, let us know. There's a lot of moving parts, variables. There's older pensions for legacy employees. There's time accrued in each plan. Your age at accrual, retirement date, retirement age, Social Security integration. So a lot to consider here. Never mind the fact that most people haven't employed the help of a financial planning firm to find out if they're on track to quit to have the choice to quit working and make work optional when they like anyway, which is what we do here. So if you have any questions about this, you never have to be a client to ask a question. We can help work with HR, conference calls, Zoom meetings, to do all the talking for you and help make sense of this, because again, it is extremely complicated and we want to make things simple for you. In fact, we find it fun and we get a kick out of making things simple, these complicated things. So, all right, let's briefly, because there's not a whole lot to say here, let's briefly talk about the deferred comp plan. So the nationwide deferred comp 457 is the tax code for this plan, is an executive benefit plan. Again, not everybody receives this or has the option to. This is for typically executives, highly compensated employees, VPs, SVPs, directors. So the way it works is it's on top of your 401k. Think of it almost like a second 401k. It's the ability to put more money away above and beyond the 401k on a tax deductible basis. So if you want to defer more taxes, save more money for yourself, but reduce your tax bill, and you're already maxing out the 401k, then this is one really great way to do it. The max contribution is $17,500. Again, this is on top of the 401k, or $23,000 if you're over 50 years of age, so the catch-up contribution for over 50. There is no match, so there's no matching contribution here. Any withdrawals are taxed at ordinary income, just like the 401k, because again, when you get a deduction up front, you're saving tax today, so it's never been taxed, and therefore when it comes out, it gets taxed later. Ideally, of course, when your tax bracket is lower, when you're not working and making as much money. It's great for those who have high income that have run out of options to reduce taxes. Again, they've maxed out their 401k, they're getting their match, and they're still just getting taxed to death. And they have extra discretionary money they could be saving for themselves, as opposed to putting it into something like a Roth IRA or backdoor Roth IRA or a brokerage account. We could use this first to reduce their tax bill, which would make a lot of sense. So if you've already maxed out the benefits vehicles such as your 401k, your college savings plan, 529 if you have kids, to take advantage of state of Ohio tax deductions, because you can get up to a $4,000 state tax deduction in Ohio for up to $4,000 contributions per account. If your spouse's retirement plans or partner's retirement plans at work, if you've maxed those out as well, then again, the 457 can make a lot of sense. One thing I just want to throw in as a caveat: 457 plans, Nationwide's deferred comp plan is unsecured. So if Nationwide went belly up, the 457 money would be lost. But just keep in mind this is highly unlikely. So don't let that scare you. All right, a couple more things about the deferred comp plan here. You choose the date in which you would like to receive it in the future. So if you choose to receive it in 5 years, when the date comes up for you to start receiving benefits, you have a one-time option to defer it again. But let's just say you retire at 52 early and you want to take it at 57, you can do that. There's no penalties. So early withdrawals before 59 and a half that you would normally be penalized for with Roth IRAs, traditional IRAs, 401ks, there is no penalty with deferred comp. You cannot take the money out until you leave the company, though, so you can't start taking it out while you're still working. So think of it as an extra 401k plan, even though technically it's a 457 plan from the viewpoint of the IRS and ERISA, which is like the IRS of 401k or retirement plans. And lastly, if you like a second opinion on your retirement plan, want help with your 401k pension stuff through Nationwide, if you don't work in Nationwide anymore, and you want help with your old 401k, old pension plans, and you're looking to consolidate things, and you want to kind of get your financial house in order, that's what we do here. So we'd love to help. A couple just kind of housekeeping items, a couple last minute things to share before we close out. First is the health savings account, the HSA account. Nationwide does have an HSA account, and they'll match up to $1,000 per year of your contributions. Those contributions are tax deductible to you. Again, you save taxes when you put money in. And when the money is used for qualified medical expenses, the proceeds, when you take money out, are tax-free. So you talk about a double whammy here in a good way. This is great. HSA plans are wonderful. Account balance, you can actually invest it for higher growth potential once certain minimums are met. And a little trick here, a little tip, is as opposed to using your HSA right now to fund your expenses throughout the year, which again would be tax deductible on the way into the HSA and tax-free on the way out. Something you can do, and something I personally do, is keep a spreadsheet of all my medical expenses by year, and I pay for all my medical expenses on a credit card, pay it off every month, and I keep track of all those medical expenses, so I have record of them. And then we can do is invest your HSA, and instead of taking money out of that HSA account, you can use after-tax money for your medical expenses now, which allows your HSA to grow tax-deferred and compound over time. And then later on down the road, when you want to start taking the money out, it almost becomes like another a mega Roth IRA. Because remember, Roth IRAs are after-tax on the way in and tax-free on the way out. HSAs are pre-tax, tax-deductible on the way in and tax-free on the way out if used for medical expenses, but you have to have record of those medical expenses taking place. So just keep track of the numbers if you don't mind being a little bit of a nerd, and it can pay dividends for you in the end. So to close out here, I kind of joked, is this all clear as mud at this point? Probably. And it doesn't matter which plan you need help with, whether it's the Nationwide Savings Plan, 401k plan, the Nationwide Retirement Plan, which is the pension plan if you apply, if you're even eligible. The Nationwide Deferred Compensation Plan, the 457 plan, or the HSA plan. We're able to help with any of these things. We know them well. Our job is basically to help keep things simple by assisting with phone calls to HR, Fidelity, helping with your old 401k plans, IRAs, Roth IRAs, brokerage accounts, trust accounts, and so on. Build a full-blown comprehensive financial plan, an income plan, to make sure that you're on track to quitting when you'd like to have the choice to quit working. And then more importantly, when you're done working, when you retire, to make sure you stay that way. In other words, to make sure that we're conservatively managing the money in the best way possible to make sure you never ever have to go back to work, and that you don't have to worry about money instead, and you don't have to stress about this kind of stuff when you should just be enjoying your retirement and enjoying your, every day is Saturday and hanging out with your friends, family, kids, grandkids, and so on. So if you have any questions at all, please know you can always reach out to us. Here's our contact information. We're over at the corner again of Henderson and Riverside Road near Upper Arlington. Our website is libertaswealth.com. If you'd like to get a second opinion on your retirement plan, financial plan, estate plan, your investment management, questions about the Nationwide plan, or any plan for that matter, you can reach out to us at libertaswealth.com. Click on the little button that says click here to get help. Or something like that. I can't remember what it says at the bottom there, but basically you'll answer a few questions and you get an intro call on the calendar with me. And that intro call, all we'll do is just chit chat, get to know each other a little bit, see if there's any questions you have, and if there's any reason for us to move forward together as a team, great. If not, we part as friends. You can follow us on Twitter at Adam Koos or Libertas WM. You can follow us on Facebook, Instagram, LinkedIn. You can find me there. And again, you can reach out to us anytime. You can email us at info@libertaswealth.com. Call us at 614-543-1350 with any questions. And once again, our website there at libertaswealth.com. So thank you so much if you made it all the way through this, thank you so much for taking the time to watch this tutorial. I hope it was valuable. And if you have any questions at all, just know that we're always here to help.